Okay, thank you, Paul. And just before I jump into the presentation, I might just do a bit of an overview of the Australian the conversation that started last night with the Agribusiness Australia function. So pre-farm gate, we had the target that was set about 5 or 6 years ago. I think we're sitting at about 45 billion production pre-farm gate at that stage, and the target was set for 2030 to hit 100 billion. Post-farm gate, so if we look at the full supply chain, there's another doubling of that. So the target in 2030 for post-farm gate is 200 million. So a combination, 300 billion contribution to Australia's economy. I think when we look through the period, and Paul referenced periods back 15 years, 20 years, and a bunch of other familiar faces in the audience today that have been part of the whole evolution of agriculture through that period, there was innovation and sustainability. Sustainability's always been core in Australian agribusiness. It's always been core. It's in the core DNA of every farmer across Australia. And this is the whole approach to managing the environment, the water, the skies, the crops, the animals, etc. But I think so. That's always been core. But there has always been a trade-off of innovation and productivity and commercial outcomes. And I think we've hit a period now, in this period, with digital infrastructure around Australia being at a level that can support a lot of the technology uplift. We're at a point now where we can combine productivity, profitability and sustainability all at the same time. And I think this is the critical, most exciting part of what we're doing. And many people in the audience are part of what we're doing. There were massive waves back there when I first entered the industry as a research agronomist, massive waves with precision agriculture, conservation tillage, etc., in my Monsanto days. But now we're at a point where we can have our cake and eat it. We can have profitability, productivity and sustainability pre-farm gate and post-farm gate. And I think as I lead into the presentation I'm doing today, what I want to focus on as a publicly listed company is that for sustainability to be able to fund programs through all the ESG initiatives around the country, you have to be commercially viable. So you can dream, you can chase butterflies, but if you're not making money, generating cash and being able to support the innovation and sustainability, you're wasting your time. So I think a core message that I'd be surprised if many people disagree with, and I hope our governments understand that message about sustainability and being commercially viable at a macro level. So the way I thought I'd approach it, and I'll go through it pretty quickly, is talk about the business model, because the business model that we put in place all those years ago that Paul mentioned was around ensuring that in bad seasons you make okay money, in good seasons make fantastic money. And when you look at the slides, you'll see that in last year in good season, record profitability, but you'll see also in bad seasons, 100-year drought in the east, acceptable money, good returns, high return on capital. I then thought I'd look at the sustainable growth initiatives and run through the Agchem plan, which many are familiar with, and then jump on a particular focus on sustainability. But I'll do it very quickly because it's a 20-minute presentation. So then looking at the business model, so multiple products, multiple services, multiple diversifications, and the key part of this is a portfolio approach, return on capital portfolio approach, which has you, like, if you can't bump the return on capital above 15% in one area, either reduce it or fix it. And alternatively add other areas of high return on capital. So there are different return on capital profiles, different capital intensity. The two highest capital intensity areas there are the rural products area and the feed and processing area. And the others, whether it be the various real estate products, financial services products, technical services products, are very, very high return on capital. So that blend is critical, and how we come to be able to commit to a 5 to 10% growth through the cycles of earnings per share and EBIT at a return on capital above 15%. So then when we look, so what's actually happened through the period, because something that Paul and I have talked about quite a bit, saying things, committing things is one, and doing them and achieving them is another. And so with that highly financially disciplined approach, portfolio approach, having a cost and capital based reset in agriculture to make money in bad seasons and really good money in good seasons. You can see the performance over that period. And I think everyone's experienced the droughts, the bushfires, the pandemics, the floods, and through that period, as you'll see later, the CAGR for Elders is 25% over a commitment of 5 to 10% growth through the cycles. I should return to the 5 to 10%. Where we got that from was a survey of our shareholders. What do you want? Agricultural company, everyone immediately thinks cyclical and punishes the PE. But you can take the cycles out with the right business model and the right strategy. So that's where it came from. The consensus was 5 to 10% of consistent growth at above 15% return on capital is an acceptable investment grade stock. And as you look through that pathway, at a share which isn't a dominant market share across the broad market share, because there's shares by different products and services, there's significant room for growth and significant plans for growth. Okay, so then we look at the historical performance, and there's a decision announced in November, which has had a bit of an impact on the share price since then. This sustainable growth, sustainable development of the business is the key, and it underpins all the other strategies. Oh, sorry, back one. So in terms of the metrics over the period, and again, just to see the trend lines with the 25% CAGR at underlying EBIT, very strong earnings per share, and the basic trend line. And you can see that this is an agricultural business. Diversifications, cost of capital management allow you to have a sustainable position. I think when we look at the diversifications, just quickly going through the diversifications in terms of product performance, again, you can see the ups and downs balancing themselves out. Where you have livestock being impacted, you may get an upside in raw products. A livestock downside will be an upside in the feed and processing business, based on the cost of goods going into our feed and processing business. Again, in terms of the diversification, just showing a different way in terms of the ups and downs, and you can see there the agency services having a hit, but a number of the others being strong and offsetting the downside. So all of these slides, it'll be on the ASX, and largely they're coming from the half-year presentation from a couple of weeks ago. Geographical diversification, and the multiple diversification is so critical. We're seeing all the talk on El Nino now. And I think we often joke about a pot plant dies in an analyst's office in Pitt Street, and there's a drought across Australia. Clearly, there aren't droughts across the whole of Australia at any one time. So geographical diversification adds to the product and service diversification, the channel diversification, and the business model diversification with their direct positions, as well as agency positions. And further trend lines of sustainable growth. So I think the final area that I'd comment on with a sustainability strategy is having the best people, having the most engaged people. And I think if we look at the middle slide there, in terms of engagement enablement, it's something that Elders has benefited from significantly. Of all the companies I've run, Elders has had the highest engagement enablement. So these are the top 5% of all Australian companies. And I think it's around the core DNA, longevity and commitment to a sustainable environment for regional rural communities across Australia. So this is the 184th year of Elders, and it does make a significant difference in how you achieve your strategy. Okay, so just jumping now to the 8-point plan, a very simple operating plan that's been helpful for the business. But if you look at our ambition, we've talked about the shareholder returns at 5 to 10%, the industry-leading sustainability outcomes, and we feel we're in a good position, and particularly through regional and rural Australia with the Nutrient colleagues and Delta and many other independents, but particularly there's some capital and strength in the balance sheet to support regional and rural Australia in multiple areas of ESG. And I think we all do our best and do a great job. Our people are clearly fully engaged, and it's such an important component of a business in regional and rural Australia. Elders has been the most trusted agribusiness brand for the last few years, and really that's also something that I think we're proud of. It just goes to the core DNA of these sorts of businesses in regional and rural Australia. Looking at the strategic priorities, the customer position, the balanced growth products, as I say, with our strategy of a portfolio, return on capital portfolio based approach to our business. The enhanced margin through largely through our backward integration programs, and then leading sustainability and productivity to benefit customers and communities. I think looking at the enablers, we have a bunch of enablers there, but we clearly can't underrate the people, but also the financial discipline, the hardcore financial discipline. In terms of our sustainability journey, in my mind, it started 184 years ago, and as per my introductory comments around farmers and regional and rural Australia, I think for us, we formally started putting a sustainability report together, gathering data, benchmarking, setting our targets, etc., 4 or 5 years ago, and we feel very, very comfortable that we're on track. But as we all know, there are many, many innovations and initiatives, and in an era where you combine productivity, sustainability, and profitability, it's really set for an exciting next 10 years. The growth pillars of the business. Just running in on our geographical expansion to further enhance the diversification, backward integration to enhance profitability, and we have a trade-off there because with backward integration you're holding more stock, but the margin uplift is net ROC positive, so quite important. Although there may be some smiles in the room where late seasons and shortened supply chains mean you sit on a lot of stock, and for us with a March half year. Which is the most awkward half year if you're waiting for a winter crop to come on board. It looks for very bad results at half year, but it all washes out by the full year. The transformational projects that we're reinvesting in the business, and also new channels to market that we're investigating. So I think finally being able to be commercially viable, have money to reinvest in the business and in regional and rural Australia in order to really drive all of the ESG outcomes, but in particularly specific sustainability outcomes, is really, I think, the combination that we're at now. So with that, Paul, I'll just open up for questions, if that's okay.
That is perfect. And we've got Max in the back from Pack Partners, and Caleb, if you like, you might like to grab another one of those microphones and go across to the left. So we much prefer to have, Tim. Caleb, could you just give Tim Gerard a call here from Henderson Group?
Thanks, Mark. Can you hear that? Yeah. Just a quick one. I guess you haven't really talked about carbon emissions, and you've got a big cattle business. What, in terms of your scope 1, 2, and 3, what are the kind of plans to reduce those? How significant are they? And where are your thoughts on like a science-based initiative down the track if it's not already underway?
Yeah, I think for the cattle business, the large proportion of the cattle business is an agency business, and so that's like a trading and commission payments on cattle and livestock coming through. So if we focus in where we've got direct a responsibility, it'll be with our feed and processing business where there's 20 of those 1,000 cattle. We're working within the industry with the Fertilisers Association and with MLA, as are a number of people across the room, on carbon emissions for our projects on research, and we're basically running with the industry. Obviously, we're letting pay to the industry in that respect. So our sense is that it's a bigger question. We're part of it, but we're not a major part of it, and we're running with those programs. In terms of a lot of the cover markets, etc. I mean, our thinking is that there's a lot of fizz and bubble, but in terms of a stable, regulated, clear market, we're a little bit cautious in getting into technical advice recommendations. We're doing a bit through our agronomic advice, but our sense is that we need a stable, clear, defined market in order to be really able to help our client base.
Okay. Just to, I suppose, stretch that discussion out that Tim started, how do you actually view sustainability on a sort of a multifaceted view? Because we've got perhaps at the moment an over-focused on carbon with the driving force of the Labor government and others and the media. I would imagine there's at least 10 type measures you're looking at. Yeah. How do you make sure that actually happens? As you say, there's a culture, but how do you as a team drive it and ensure that, when you do move on, that, Elders is that sustainable culture, both from a sustainability point of view, but from a cash flow point of view, please?
Yeah, I think it's a good question. I think in an era that I flagged earlier, where you can have sustainable outcomes with commercial outcomes and profitability outcomes, I think it's a much stronger ecosystem to be operating in. The work, and just as a minor example, the solar work that we're doing at our feedlot is commercially viable, and so for us, it's not about virtue signalling or wanting to put something in a PowerPoint slide or in an annual report. This makes money, makes sense, and it's the right outcome. And I think that authenticity in our approach is probably more important, I think. In terms of the precision agriculture, the regenerative agriculture, et cetera, these have been around for a long, long time and are core in the toolbox of every agronomist across Australia. And they're rebranded, renamed, re-talked about and repainted. But, for many, many years, what's changed is the technology available to deliver them. And that's what we want to be on top of.
Just the final question for me is, you take us into, say, the Elders, group sessions that you have. So you'd be having these sorts of sessions with even more people. When you mention sustainability and sustainable cash flow, how many people sort of roll their eyes and sort of leave the room, and what actually goes on inside the office and inside the team?
So we've got other subject areas that have people rolling their eyes and leaving the room, but not sustainability. I mean, again, this is core to how agriculture works. It's not magic. I mean, the whole animal welfare debate I find quite fascinating, because an animal is an asset. It's worth a lot of money. Looking after it and having it, it's most productive when it's most happy. And I mean, this is just basic stuff. And therefore, to me, it's just, this is how agriculture is. And we have outliers. We have people getting around the system, and there are consequences. We see the live sheep out of Western Australia, the consequences of pushing the envelope and having overloaded boats in dangerous temperature regimes. I mean, that's not the core of how agriculture people think. So we get no pushback on sustainability through the business, and really if I think of some of the other ESG agendas, the only pushback we'd get, and I'm sure Kelly and Jared get the same pushback, is finding people, in terms of a diversity measure, finding people in regional rural Australia who can fill roles that fit all the categories is very, very difficult. So it's a very practical, authentic pushback, and not a biased or a mindset pushback.
Anthony, just a really quick one, Max.
Thank you, Mark. Anthony Wilmot from DAS. A quick question. We're seeing in the financial service industry in this conversation, kind of two conversations for farmers in particular. One argument is that farmers will trade carbon, will be part of their income source. The other is that they'll need to retain those credits just to sell their product, cost of doing business as such, to secure markets. Does Elders have a perspective where that pendulum's going to fall? Because it's swinging about a bit at the moment.
I think I gave my comment on the immaturity of the market and the immaturity, the clarity of what's up and what's down. And that's the danger, because if you're making recommendations, like you're their fourth or fifth generation client, and you're making recommendations about locking up paddocks and guaranteeing contracts, and then the regulatory framework changes, where you sit, and it's just not right and not appropriate. So, without wanting to be wishy-washy, so with that immaturity, it's very difficult. It's very difficult to make a call.
It's fantastic. Great kickoff, Mark, and the questions. Please keep the questions rolling for the next session. So,
Yeah, thank you.
and Mark and others will come up for the panel.